Hey everybody, good to be here today. It's Wednesday. That means it's managing an options portfolio day. My name is Brent Moores, and we are going to manage an options portfolio. We're going to go look at some individual trades that we have, look at managing those, and I also want to talk about kind of a special topic as well, and that is I want to talk about multiple targets, perhaps. We'll get to that and answer a couple of your questions as well. Good to be here. Connie Hill is helping me out in the chat. Always appreciate Connie. She's always a great aid. As you have questions, feel free to type those in the chat between Connie and myself. We'll do our best to get those answered. You can also follow us on X at Brent Moore CS, at Connie Hill CS for additional content. Here's some disclosures to be aware of. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is for educational purposes only. All investing involves risk, including loss of principal. And rolling strategies, yeah, we actually may talk about rolling today. Rolling strategies can entail additional transaction costs, including multiple contract fees. There we go. Past performance of any security or strategy does not guarantee future results or success. And the paper money virtual trading application will not assign a short option position early, which is different from a real trading account. Okay, let's head on over to the Thinkorswim platform. This is the markets question there was a couple questions. Let me just kind of lead off with one of them. Why is the market reacting the way it is right now? Well, hey, look, we're up today. We're rebounding. We had some bad news on Friday. It added some jitters to the market. For those of you who weren't aware, we had kind of a labor report that wasn't good. And not only wasn't it good, but they did the numbers for the preceding 2 months as well and made them look worse. And so that brought some concerns to the market. But at this point, seems like the market is shrugging that off here. It seems like, and I don't know where the market's going to go. I don't know what the economy is going to do. But what I would say is this. We have a trend that's gone up. And I would not consider this, let me put on a 20-day and a 50-day moving average. We're back above the 20-day. I would not consider this a definitive trend break at this point. So from a trend trading perspective, and there's different perspectives, from a trend trading perspective, I would say the market is continuing its upward trend and we're going to continue in that path. And that's how a lot of technicians will view the market. Okay, so that's something I want to address there. Now, in terms of looking for trades, what's the first thing that traders often do as they look for trades? I think from our perspective in this class, often we start with the technical analysis. And technical analysis starts with trend, support and resistance, and then you can look at things like momentum. And therefore, given this, I think for a lot of traders, yeah, we may look to put on hedges and things, and we do sometimes in this webcast, in fact, but the majority of trades, given a bullish posture, if you're taking the trend to be bullish, will likely be bullish trades. In fact, we'll look at one here today. Okay? All right, so I'm hoping that helps you out there, John. Good questions on those. But we're taking a technical approach, even though it's not the only approach to the markets here. Josh, you have a question too, and I'm going to get to that. But let me get to into the swing of things, then we'll kind of circle back and go to your question here. Okay, I'm going to pull up Citigroup for the purpose of kind of illustrating something that's I want to just take a stock that's been kind of trending up. We're going with the thesis that the stock is trending up and that trend is likely to continue. It's gone up. It's kind of given us like a little flag pattern almost, if you will. Let me just draw a flag pole on there. And then we pulled back, no doubt. And then it's then who knows? Looks like we may be bouncing. Looks like we may have found some support here. Now, the point isn't to do a trade on this. Stock isn't a recommendation or anything. But what this is, I'm just going to shrink this down a little bit because what I want to do is I want to kind of duplicate this line and just say, I'm going to go from low to high, and it's going to be putting me, this is a way of doing kind of a potential target that people do. There's different ways of doing targets, but often you'll take the previous flagpole, you'll add it to the bottom, or you can add it to the breakout as well for a more aggressive target, but that's a way of coming up with the target, about $100. Another way of coming up with targets is you can look for old resistance levels here. So I'm going to go right here and just say, hey, there's a resistance level, okay, around 96 or so. So if we're doing that and we're coming up with targets, sometimes what may happen is you may come up with, that's an old drawing, never mind that, you may come up with more than one target, okay? So here in this example, I have a target here as a potential bounce there, reasonable bounce, I think. We have a target here, which is a more ambitious, can we say, target up there. That's possible. Maybe you want to add both into your trading. And you want to do a trade that has two separate target prices. And maybe we'll even put in a stop here as well. And we'll say, well, if it goes back down here, that's we're going to get out in that case. Put in a stop there. How can you do that with the trade? You can do this on stock trades. You can do this on option trades as well. But it's part of money management. Why? Because look, you may have a target and say, well, I think it's going to go up here, but realistically, you know what? I know a lot of times it doesn't hit my target, and sometimes it goes up close and then pulls back down. And I want to take advantage of some of the gains and not bank everything on it reaching my full target. Okay? Or sometimes you can do that for the stop as well. And you can say, well, if it stops, it goes down to a certain level, I want to get out, and not all of it though. Now, obviously this is contingent upon, in the case of options, you're doing more than one contract. If I'm doing one contract, I can't sell a half a contract and sell another half a contract. But let's talk about doing this, okay? So in this example, let me just jot prices down here real quick. 196.50, I think was our target levels there. So you can do this on a stock trade. I'm trying to get rid of, there we go. Let me pull up Citigroup. And I'm going to take the stance, and just to make it simple, I'm just going to do a long call here. And I'm going to go at the money. I'm going to go about a month out. So I'll go to 5th of September. And at the money is, we're going to say $92. So we're going to look at this 92 strike here. Okay. And I'm going to look at calls, and it's right around 315, about a 5-cent bid-ask spread. And we can say, well, what if the stock, what price is the option going to be if the stock goes up to my target prices? So if the stock goes up to 96.50, what is my option price going to be? Okay. Well, 96.50 is about a $4 increase in price here. So I'm going to go to Theo Price. If you don't already have it up, you can just go right here, click on Theo Price. Make sure you go over here and you reset, because it will keep the old settings that you have on there. Maybe you looked at it 3 weeks ago or something, and it will still say, minus $5 or whatever. So I'm going to reset this, and I'm going to say, what if the stock goes up $4? We said to about 96.50. So let me go about 417 will get me right about there. It may move a little bit as we talk. Okay, close enough. So there's my 96.50 target price. And I'm going to say it takes a few days to get there. Today's the 6th. And why does that matter? Because there's a time decay on options. and that can affect things. So here's my Theo price. We're looking at the 92, and this is saying the option price could be 550 in that case. It's an approximation. It's not a guarantee, but we're going to say if the stock goes up to about 96.50, then my option price will probably be in the ballpark of 550. Okay? And I can do the same thing if the stock goes up to $100. How am I going to get this to $100? Well, the stock's at 92.30. So that's about what, $7.70 up. So I'm going to put 770. And we're going to say, how much would that option be worth? About 848. Okay. Now, I may take a slightly more, this may be, we don't know that this is what it's going to be, right? This is just an approximation. So maybe I don't go for the full amount. Maybe I knock it back a little. Maybe I just do $8 or something like that. So just my point being, don't look at the stock when it goes up to $100 and say, well, it's not at 846. It may not be, okay? It's an approximation. But we have some ideas on this right now, okay, as to what the option price would be. So let's say we wanted to do this and we wanted to put in multiple targets. How do I do that? I can right-click on this. I can buy custom with an OCO bracket, but that doesn't do it because that gives me a limit price, which is a target price, and then a stop. Instead, what I'm going to do is I'm going to change this from First Trigger's OCO to First Trigger's 2 OCO. Now, it gives me a little note. It says I need 5 orders in here for a First Trigger's 2 OCO group. So I'm just going to add in another limit order. I'm going to add in another stop order. And now, how many orders do I have? I've got 5 orders. My initial buy order. This is a limit order, which is a target. Limit is if things are doing well. And here's another limit right down here. So I've got limit to buy, limit to sell, another limit to sell, and 2 stops here on this, okay? I'm going to make these good till canceled orders because I don't want my stop orders or my target orders to expire at the end of the day today. Now, what price did we say we were going to get out at? We said we're going to have a target at 550. I jotted that down in case you don't remember. 550. So I'm going to type in 5.50. 550. That's a target price. My stop, where's my stop? I'm going to put my stop in at 50%. Okay. So we're going to say about $1.60. I'll just round up just a smidge here. I'm going to say that's going to be $1.60 stop. Okay. And I'm going to do that on both of these. Oh, by the way, before I forget, I'm doing 2 contracts. Now you can do some multiple of these. You don't have to do 2, 1, 1, 1. You know, you could do 4, 2, 2, 2, or something like that. Okay. And Ted typed that in, I think, just as I realized that. Yeah, I got to do 2 contracts there. You're absolutely right on that. Okay. And we'll kind of go through this in a second. Our other target wasn't 550. Our other target was the aggressive target. It was 848, or I'm just going to say $8. Okay. I'm going to go slightly more conservative than that. Okay. Now, there we go. Now, I'm going to draw this out for you in just one sec, but let me just click on confirm and send. And here's my trade. This is going to be a long call option. We're buying 2 contracts. Okay. If the stock goes up, if the option goes up and hits our 550 target, that's my initial target, we're going to sell a contract, but it's an OCO. So it's also going to cancel out one of my stops. that will go away. Okay. I will then be left with this order right here. You see that? Because we've only gotten out of one contract at that point. We bought two, we sold out of one here, and then we have another one. Are we going to hit that higher target? Maybe. If we do, then we would sell out of our other contract. We'd sell out of this, and this one would cancel because it's an OCO order. Okay, OCO stands for one cancels the other. Okay, so let me do it this way here. Okay, I'm just going to, let's go through that one more time, but let's say it goes south on us. We buy two contracts initially, and the stock goes down to 160. Okay, we're going to sell at our stop. Okay, we're going to sell at our other stop. Okay, so we sold two contracts, and these two will cancel on us. Okay, what if, let's say, the stock, we buy two contracts, and we go up and we hit one, our target, and so we cancel out of the stop. It's an OCO, one cancels the other. And then the stock goes down, and the option goes down, and we hit our stop. We're going to sell out of our other one right here, and that will do an OCO, okay? So I'm just going to send this order real quick, and I'll try and draw it out for you just one sec here, okay? So let me do this, and let's just talk about this. If I buy, it can be a stock or an option, doesn't matter, and I just buy it, that's just a single order, okay? What if the stock, what if I want to do, let's say we buy a stock or an option, okay? And we do what's called a bracket order, which is this is an OCO order. We set a limit price. I'm just going to abbreviate. A limit price, that's going to be our target, okay? That's going to be our target price. If the stock goes up and we hit that, we sell out. We're also going to set a stop price. That's the scenario where things aren't going so well. It's going down on us, okay? But if let's say I buy 100 shares of stock for a sec. Let's say I buy 100 shares of stock, and I hit my target, and I sell those 100 shares of stock. I don't want that stop order hanging around to agree to sell another 100 shares of stock. That's no good, because then I would end up with negative 100 shares of stock or short 100 shares of stock. So we do an OCO order. In other words, if the limit fills, then we're going to sell out on the stop. And it's not sell out on the stop, excuse me, we're going to cancel the stop order. It's going to go away. And vice versa. One cancels the other. So if the stop fills, the stock goes down, it's going to cancel, one is going to cancel the other. That's a traditional OCO order. One cancels the other. What I just did, though, is a first triggers, it's supposed to be a G, to OCO order. Okay. We buy a stock or an option. And after that, what's going to happen is we're going to have a limit order, which is a target price. And we're going to have a stop order, which is if things go south on us. Okay. We're going to buy two contracts of this. We're also going to have a secondary limit order, which was our more aggressive target. And we're going to have another stop. Now, that other stop can be at a different price than the first stop or the same price as the first stop. Okay. But they're both OCO orders. So this and this are connected as an OCO, and this are connected as an OCO. So if either one of these fills, it's going to cancel the other, and so on. And these are just going to be one contract, each of these. Okay. That is first triggers 2 OCO order. That is a way of coming up with multiple targets if you want to do multiple targets. And that's part of managing an options portfolio or a stock portfolio for that matter, I guess. But having multiple targets, multiple exits is a standard thing that a lot of traders will do at times. Okay. It's a little more complex, so it takes a little more time to explain. So often we don't necessarily, I don't show it each week here in this, but I wanted to make you aware of that. Now, if you have any questions on that, let me know. And then I want to address your question, Josh, here. Let me just make sure. Could you have made it a market order? On the entry, yes. So Reggie said, on that buy order that I did a limit order. And traditionally with options trades, more traders are apt to do limit orders than market orders on options trades. With stocks, probably market orders become more prevalent. But could you have done a market order on the initial trade order? Yes, you could have. So good question on there. Okay. Now, if you kind of screw this up and mess it up and put in the order wrong, in some circumstances it can protect you, but it can't protect you from everything if you put in a valid order. If you don't put in a valid order, the system won't let it go through. But if you put in a valid order and you accidentally just put in the wrong prices or something like that, yeah, you're up there. And can you set up a stop price on the second? Yes, absolutely. So Jose said, what if you want to do 2 different stop prices? You can do 2 different stop prices on that. Yes, you can. Absolutely. Okay. So, so you could do limit, which is going to be your target number 1. You can do stop. We'll call that stop number 1. We could do our secondary limit, or you could do the same as the first, but you could always change those stops to have 2 different stop levels. These can be totally different. Okay, this and this can be total different prices. Okay, so yeah, Janelle said, great question. Say, yes, I agree. Very, very good questions. Okay. So do you do this on all order? No, you only do this if you want to do multiple targets. Okay. Couple conditions. Why would you do that? Number 1, if you're doing more than one contract, as I mentioned, okay, if we're doing options. And 2, if you kind of come up with the idea that this is kind of a more aggressive target, perhaps, and then this is a less aggressive target. Sometimes you may want to split it up. Often you probably don't want to split it up. Okay. All right. So now, let me just kind of scroll through and see what other questions there are. Okay. Ted would prefer a walk limit. That is absolutely fine. Can we do a stop price? Yes, we did. We answered that question. Is there a way of calculating risk reward? Yeah, that's kind of what we sort of did in a sense. Because remember, we said, we said we were doing a stop at 160. Okay, that was where the stop we put in. And we said we did a target, I'm just going to pick one target here, at 550. Okay. My entry price on this was, we'll say 315. How do we calculate a risk reward? You take the difference here. What's the difference between 315 and 550? That's $2.35, I think. If I'm doing my math right, I think I'm doing it right. My stop is, well, it's about $1.60, $1.55, I guess. That assumes, of course, we get stopped out at that price, which is no guarantee. We don't know what price we're going to get stopped out at. This is our reward. This is our risk. Okay. Now, we had a separate target price too. Or our separate target price was 8 something or other. You would do the same thing. Difference between your entry price and your target, take the difference there. That's your reward. Take the difference between your entry price and your stop. That's your presumed risk there. Now, your true risk is you could lose it all, right? This could go to zero. This could just gap down on us. Okay? All right. Now, one thing to be careful on, one thing to be aware of is your liquidity on these. Okay? We've got a 5-cent bid-ask spread. And Josh did a trade. And the trade is kind of, he did a long call vertical spread. Okay? And what happened with the long call vertical is, what do you expect if the stock goes up? Well, you expect to make money on the trade. Okay. You expect the long call. Remember, if you're doing a long call vertical, you got a long call at a lower strike. You've got a short call at a higher strike. And if the stock goes up, maybe they're both in the money even, you expect the long call to go up at least as much as the short call, because presumably the long call has a higher delta than that short call. So you'd think it to go up just as much. Well, what Josh encountered was, in this situation, the stock went up and the short call actually went up more than the long call, which means he's actually losing money on that. Well, here's my take on that. Typically, that's more of a temporary condition. The prices will kind of equalize. A lot of times it's a liquidity issue, okay? And it's a spread issue, a bid-ask spread issue. And in fact, I think maybe I saw, Josh, somewhere you said that the spread was pretty wide. And that's what happens when the spread goes pretty wide. Now, here's the thing. In the case of a long call vertical, theoretically, you could just let it go all the way to expiration and have both contracts exercise and assign, okay? And you end up with a difference there on those. But often with the difference in spread and liquidity issues, over time, they will kind of equalize themselves and you'll be back to showing a profit. I can't make any guarantee on that, but often if you're patient with that, it will kind of work itself out there. So yeah, Josh typed in, spread is wide on the long call, but tight on the short call. That's because that goes out of money. Typically, your spreads are going to be tightest when kind of the ones that are closest to the money. Okay, closest to the money tend to have the highest liquidity, and that's the issue you're dealing with there on that. So I'm glad you brought that up. Now, I want to get to some trade management here, though, before we run out of time, because I think there's some interesting ones that maybe we want to look at. And I'm not going to go in order, but because there's some that I want to consider here. I want to look at AbbVie here, okay? Because AbbVie, what do we have on AbbVie? Look at this trade, okay? So on AbbVie, we've got same strike, different expirations. One of the expirations is only in 2 days, okay? This is a calendar spread. Where do we want the stock to go on a calendar spread? We want it to go where the strike price is. By the way, there's a survey link in the chat. We appreciate your feedback. We want the stock to go to basically 190. Well, we're at 195. So it's not exactly where ideal is, but we're still doing okay on the trade. We're still making some money on this. But we either have to just get out of the thing because we're about to expire anyway, or we can roll. And now, if these are only, like if they expire a week or two apart, we're probably not going to roll the short contract out to a later date. But in this case, there's an adequate gap between those two, between 2 days and 44 days. So we can roll to some intermediate position there. So let's kind of look at the situation here. And to do so, what I'm going to do is I'm going to go to the Analyze tab, and I'm going to go to, well, let's do ABV, A-B-B-V, okay? And so this is what it looks like right now. This is the current stock price on this. And I'm gonna look to roll this, as I said. But look, the stock's up here. So it may make sense not to keep it at 190. If I keep it at 190, that's the true calendar. If I roll it, in fact, David typed in the chat, roll out and up. If I roll this up maybe to 195, that'd be rolling it out and up. Let's just kind of model that for a sec here. So let me go to August 29th, which is kind of in the intermediate position. And these are puts. So let me go to the put side of the equation here. And we're going to look to maybe, I'm going to click on the 190 and I'm going to click on the 195, and let's look at the two differences here, okay? So let me get rid of this and this. This is where we currently are. And notice where the peak profit is on this is if we stay at 190. Now, if we roll out to the 190, get rid of this one and roll it to this one, where's our peak profit? It's still 190, because at this point it's the calendar spread 190. Now, the thing is, in the process of rolling, I'd be let's see, let me just go out. So we'd be buying this one back and we'd be selling one of those, okay? The alternative to this, though, is this. We could, instead of rolling to that, we could roll to the 195, and look how this looks different. Instead of the graph looking kind of like this, do you see how we've which is kind of non-directional? I mean, technically it's slightly directional in that the stock's up here right now, but in this case, we're moving up our center point up to the current, where the stock currently is. We're adjusting. You can adjust as we go. Now, it doesn't just shift it over, it actually makes it so that if this goes bullish, then it actually just kind of, that's where that is here. Let me just actually, hold on one sec. Let me get rid and okay, those are unchecked. Okay. This keeps us on the good side of the equation here if the stock goes up, but if it goes down, then it's even worse, okay? Look, our max loss here is about 875 if I do that roll to the higher strike. If I don't do the roll to the higher strike, then my max loss is about 546, okay? So there's pros and cons. The pro of rolling to the higher strike is we're adjusting it closer to where the stock currently is. Let's just look at that stock. In general, I'd say that maybe makes sense. Look, we've got a trend that more or less is kind of meandering up. Not a super strong trend, but it's going up. And so making our peak profit point around 195 may make sense in that case. Okay, so that's what you can do on that when you can roll. So how am I going to roll? How are we going to do this? Remember, rolling, there's multiple commissions involved. And one thing we could do is we could just get out of this one and then do a separate trade and enter the new contract. But what I'm going to do is I'm going to right click on the one I want to change. I'm going to create a rolling order. It's going to say calendar, but here's we go. This is what it does. It rolls it out. Now, It doesn't know what strike I want to roll to. It doesn't know what date I want to roll to. We said I wanted to roll to August 29th, and we wanted to roll to a 195 strike. So in this case, we're going to get out of this one. We're going to enter this one. It is bringing in about approximately a $390 credit. Not factoring in commissions here or fees, but that's why we roll, is to bring in those credits along the way. That's a nice thing because that's eating into the cost of the original trade if we do that. So let me do this, and I just want to make sure this fills here. So I'm going to move this down a little bit here. I'm going to confirm and send, and I'm going to send this. Okay, we filled. Now let's look at our new trade here. Okay, AbbVie, new trade. It looks kind of like the other one, but now our strikes are different. We essentially just move this in a way to be this, okay? This is now a diagonal spread, not a calendar spread anymore, but we brought in the credit on this. And if we want, what we can do is we can look back at our trade history on AbbVie. Let me go to trade history. We're going to go to ABBV. And let me go back more than 8 days. I don't know how long we've been in this, but let's do 30 and see if we can get, yeah, here we go. Okay, so this is how you can look back at your trade history on this. You can look back and see, hey, we did a calendar up front on 7/14, July 14th. It cost us $200. We rolled it out. We brought in that credit there at this point. Okay, we brought in a $379 credit, not factoring commissions there. That's why we roll, and that furthermore isn't just rolling out, but we've adjusted the strikes on that a little bit too. Okay, so that is a rollout and up on AbbVie. We're going to leave that as is here. Now, let's look at some others here. Let me go and I want to kind of I'm going to go a little quicker on some of these others because I'm going to run out of time here. Alphabet, okay? And so what do we got on Alphabet? We got a short put vertical, okay? So this is a bullish trade. We're down a little bit on this right now, okay? Things aren't going well. When are we going to get out of this? Well, less than 10 days, about a week to go or so. We're looking to get out probably. Okay. And 23 days to go to expiration. So we got time on this. The spread is a $5 spread. And right now, there's about $1.30 on this difference on this. So we've lost some money, but by no means, if this goes real south on this, this would reflect something like a $5 difference here in our mark price on that. Well, we're not going to have that. We're not anywhere near that. So it's not going well by any means, but it's also not disastrous. So really in this case, what I would say in terms of management is your initial thesis on the trade, that is, this is a bullish trade, still intact? Okay? Well, let's look at it. Are we still bullish on Google? Now, you may have a different opinion from anybody else on this, but I'm going to go with what I said before and say this trend is still going up. We're going to be patient on that and let that run. Okay, so that's Alphabet. Okay, let's look at some others. Let's go to long single options. Here I have Adobe. I've got just a long put on Adobe, and it's doing well. I'm not going to roll it. I discussed this in my long options class. Okay, my long options class yesterday, I talked about this. That's on Tuesdays at 1 o'clock Eastern time. But so we're not going to roll. It's going well, but a lot of times in that class, we'll look for a delta to be 80 or above and we'll roll. We're close, But one thing I want to make sure on is my stop makes sense, because I did the trade when the option was $24. Now it's about a $47 option. Where's our stop? Our stop's down at $22. We had moved it up at some point, but it seems like it's time to move it up again, probably, because if I have a $22 stop, that's less than half of the current price. And with the delta up there, I'm going to make that stop around 70% of the current price. So I'm going to go 0.7 on my calculator to times 47.67, and that gives me about a 33.30 stop. So I'm going to adjust that stop to try and help protect us on this. So the way I can do that is I can click on the sell. Here's my existing stop. I can right click on this. I can cancel and replace this order. And we said, oh boy, I already forgot what price I had. 0.7 times 47.60, 33.30. That's right. Okay. So I'm going to put this at 33.3, 33.3. Good till canceled. Confirm and send. And I'm going to send. Okay. This canceled our other stop. And we are, it's now replaced it, if I click on this, with this new stop. We've tightened up the stop there on that. Okay. All right. Okay, let me just, I'm going to wrap up here, but let me just address some questions. Chris said, yeah, the thing is when we rolled, when you start looking at that roll there, what did we do? We did AbbVie. Look, this is now showing that PL open is way down because it's not reflecting the whole trade. So you're right. That's a challenge on that. That's why you got to look back. As Connie mentioned, you can use a trading journal. You can also go back, like I said, in the account statement and look at what's happened on that. But yeah, the PL open isn't going to tell you the true picture of the whole trade in there. Okay. Let's see. And let me just finish up with this. John said, if I'm buying a put, I want the stock to go down. If you're buying a put, you do want the stock to go down, but you want the option price to go up. Okay, don't ever confuse that. If you're new to options, if you buy a put, you want the option price to go up. Now, the option price is going to go up if the stock goes down, probably, but just don't confuse those things if you're buying a put. All right, everybody. Hey, thanks for joining me. What did we talk about? We talked about doing multiple targets, how to actually enter those orders on the system. We also talked about managing trades. In this case, we talked about rolling a calendar into a diagonal spread to try and take advantage of the current conditions. And we talked about managing a short vertical on Alphabet and moving up a stop on a long put trade. Okay. Hey, thanks for joining me, everybody. Coming up next, we've got trading price patterns. And so I think Kevin's teaching that class, and I'll be in the chat on that. But thanks, Connie, for helping me out. Thank you each for taking some time out of your day and joining me. And we'll see you all same time next week. Bye-bye, everybody.